Hello traders, Gary Wagner here, just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is October the 7th, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine it with trending markets to take a look at activity that occurred this week in the markets, as well as our forecast for markets next week. Now, we culminate or end the week with a major reported jobs report, which came out today. September saw 156,000 new jobs added, and the good news on that was there was a vast percentage of those that were professional jobs. Now, that put some early pressure on the equities markets, trading off about 100 points, but closing only fractionally lower on the day, and we'll look at that in a second. But as for the precious metals, although we have seen literally the worst week in gold in terms of the drawdown since 2013, at least for today, we're going to end on a solid note on the day, but definitely taking some damage on our weekly charts. And of course, we'll look at that in a second. First to gold. Gold closing up about $4 on the day, $12.57. That's December COMEX. Low on the day is $12.43 with a high of $12.67. Net change approximately 33%. When we look at spot gold, spot is in essence unchanged, up about $1 at $12.55. Low $12.41.50 and the high $12.65.40. Now, silver, which had been under dynamic pressure throughout the week, is closing up with about a 1% gain on the day, a $17.48. That's our current spot print, putting it up, as I said, $18.19 with a high of $17.65 and a low of $17.11. And then lastly, we do want to look at COMEX silver trading up almost a full percentage at 71.51. Let's take a look at our first chart. What a week in gold. Selling off tremendously. And in terms of the actual drawdown itself, this is a bar chart, weekly chart. You can see that the market was trading above 1320 at the beginning of the week and then traded to a low right in here at just above 1240. So approximately an $80 drop in the price of gold over this short time period. Now, did it cause long-term damage? Well, that will have to be something that we will see in the weeks ahead, but my sense is we absolutely caused some chart damage, no doubt about it. But I also see a tremendous opportunity with this recent decline. Now, I want to look at a couple of different charts. This first chart that we're looking at, as I said, is a weekly chart. We have one basic fib retracement, same one that we use from our daily chart, which goes from this rally, which began at 1200 to 1376, about 175-dollar rally. When we put that into perspective, this recent decline here was approximately a 78% retracement of that move. So that's a pretty sizable move. And the fact that it went beyond a 61% retracement, which is a deep retracement nonetheless, but it's what we effectively look at as a boundary for deep retracements. We did go past that to the 78% retracement level. Now, that is still a valid retracement. And what I mean by valid retracement is a market that moves up a couple of dollars and retraces 78% can still be seen as on an upward tact if it's in a bullish cycle. The opposite, of course, is true for a bearish cycle. So 78 is not out of the borders, let's say, of what we can see, but it is a pretty hefty move. Now, with that in mind, I do want to take a look at our daily chart. And traders, our daily chart contains two fib retracement levels that are important. The first one is basically or exactly the same as what we looked at in the weekly, from 1200 up to 1375, let's say. And then we have another fib retracement, and this one is a real critical retracement level because it really accounts for the lows of the year, which came in end of last year, beginning of this year at around 1050, up to, at this point, the record high that we saw this year at approximately 1378. And the important number to look at is going to be our 38% retracement, and that comes in at 1247. So consider this. We've got a 38% retracement of this large move. We have a 78% retracement of this last rally. And all of that falls within the confines in terms of a range right here in between, call it 1238 on the low and 1247 or 1250 on the high. And this is the target I am looking at as a potential bottom in the market. It's not exactly a double harmonics because these numbers are fairly far apart. You've got 47 and 38, so a $9 difference between the two. But here's what I'm looking at. Just as we talked about a few days ago, right after this really precipitous drop in which we saw the market drop, $42 on the day, we had this consolidating doji candle come in. And I talked about a pattern simply called a three-river morning star. Now, a three-river morning star is one variable of a key reversal pattern, a candlestick pattern that is very, very accurate, I believe, in picking bottoms of the market, the three-river evening star, of course, in picking tops. Now, the criteria to have that pattern is first, after a defined downtrend, we certainly can say that we met that criteria here. You get a red candle first, a long red candle. That is the first candlestick in the pattern. You then get a star. Color is not so important within the star itself. What is important is body size, that it maintains and contains a very, very small body, a doji-like candle. We got that this week, and we have that occurring again on today's trading activity. Now, to complete the pattern, of course, you would have to have the following day, meaning Monday's trading would have to be a long green candle with a higher high and a higher low. These three candles, of course, would complete the three-river morning star pattern, as you can see the example right over here. But you wouldn't take that call really until you got a confirming candle, which would be like this green candle here. Now, there are other variations, of course, for pivot points or key reversals in candlesticks. A common one is an engulfing bullish, a piercing line, as well as a bullish harami. However, the most important thing to remember is that if we do identify one of these patterns forming next week, it will give us an excellent opportunity to enter the market from the long side. Of course, we will send out a special trade alert with our recommendation to enter the market from the long side, as well as our recommendation for a protective stop. So traders, what about silver? We identified over the last couple of weeks the fact that we definitely had a pattern that was developing in which we could identify a support line from a series of lows, as well as a resistance line from these recent highs in the market. And we noticed that we absolutely had a narrowing and contracting range. As you can see, as this market traded through these different levels, this range on each apparent move was compressed from the range that was previously noted until we reached the apex of the triangle. We did get a sizable break. This is a daily chart, and you can see that we noticed this, in fact, last week, and then the follow-through was tremendous in terms of the drawdown itself, considering that the market silver itself was trading at around $19.50, just shy of that, and then traded to a low of just above $17. That is quite a move. Now, we might issue a buy recommendation if the criteria is met that we're looking for in gold as well as in silver. But there's a couple of very critical levels that we really want to be aware of. And the primary level that I'm looking at is this former top right here, which comes in roughly at $18, as well as a secondary support level at about 1740, and that is our 50% fib retracement. Now, we closed just over that at 1754. But for me to really get bullish on silver right now, I do want to see a move back above, call it 1780 to 1790 to fulfill and to come back over the 61% retracement of this particular fib retracement that we're looking at. So silver could certainly be in a scenario in which we'll see some sort of a setup come into the market, and we might also issue a buy signal. And that, again, we will send out a special trade alert with buy recommendation as well as stop recommendations. Traders, just following the release of jobs data for September, we had the U.S. dollar flat under a little bit of pressure, but showing a stellar performance this week overall. As we go into the close, as you can see, dollar is now down about 1/3% at 96.50. When we take a look at the activity that we saw, of course, in the market, this being Monday, this, of course, is a daily chart that we're looking at. You can see that we had some superlative activity moving from about 95.50 all the way up to an intraday high just shy of 97, call it 25, and then it began to come down. That, of course, is on our daily chart. When we look at a weekly chart, we can see that there's been a defined and strong uptrend within gold. And on a weekly chart, it really becomes clear, and we talked about this throughout the week, and that is the fact that what we have seen is really these ascending lows. In other words, a series of higher lows. We have had some structure in terms of resistance just shy of 98 and then just shy of 97. But I would expect the dollar overall to have strength in the market over the next couple of weeks. Let's even go as far as October. As we get closer to November, we could see some pressure come into it, but we certainly, at least for now, are looking at a much stronger dollar. We have seen a sizable upside move in crude oil this week, actually hitting some lows last week of approximately $43 a barrel, breaking above 50 yesterday, and then closing slightly lower off about 1.5% today at 49.59, putting it off roughly 85 cents a barrel on the day. Now, there's a particular chart that we have been looking at all week. Let me go ahead and kind of bring that up. And traders, this is a weekly chart of crude oil. We can absolutely see that it has had quite a resilient move as it hit these lows just above $42 a barrel, this being 3 weeks ago. And from there, climbed up roughly $8 plus per barrel over the last 3 weeks. We've also identified a bullish slope to the market. This is a linear regression in terms of the pattern, but we have had a sizable break above that midpoint. And if we get follow through, we could now see crude oil go as high as maybe $53 a barrel or to the top of this channel line before beginning to back off and trade lower. So I wouldn't be surprised next week to see some continued strength in crude oil, or at least stability, as long as it trades above, on a technical basis, this particular midpoint, this channel line, mid-channel line that we have just drawn in. Traders, interestingly enough, a statement by Goldman came out today, and they are saying that they see a buying opportunity in gold. If this particular slump continues, they see an incredible opportunity. As you know from our charts that we looked at on today's show, it is my sense that this recent sell-off is overdone. We have some criteria that we need to look for next week in order to ascertain whether or not gold prices have found potential support. At the point that they do find support, I think we have an excellent buy opportunity, and silver also is playing into that hand. I see these markets having come under pressure this week, giving us tremendous opportunity next week. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Have a great weekend. Bye-bye.